Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my really good friend, Alastair Macdonald. Hi, Alistair.
Mike, it's great to be with you again.
Thank you kindly for coming on the podcast. So what's new in the world of Alistair?
Oh, goodness. So many interesting puzzles coming across my desk these days with the changes that we're seeing in financial markets are likewise showing up in the cross currents of social indicators as well. This is a particularly interesting time. I think it's that the old Chinese curse, may you live in interesting times, and we definitely do. Lots of beautiful projects. Really interested to just spend time with clients and friends and get a sense of where everybody is with their own professional aspirations in light of the rise in the cost of capital, geopolitical risks, and it just really supports so much of my own lived philosophy and expectations that we're constantly in a cycle, and it's just where in the cycle are we. So knowing where we are gives me great comfort to navigate the road ahead. But interesting times for sure.
So on that line of where are we in the cycle? Are we essentially going into recession, where we already should be in a recession? And what is the grand cycle? Obviously, expansion, peak, recession, bottom. I assume we're somewhere on the way down.
Yeah, I think it's important to think about this as cycles operating at multiple degrees of scale. This is important. So to use some examples, we could be looking at intraday interest rate swings, couched inside multi-month cycles, couched inside much larger 40-year interest rate cycle that we've been through from 1981 to 2020. And this shows up likewise in standard kind of technical analysis. You've got Contrarian wave cycles that are lasting 75, 76 years, all the way down to jugular cycles and these types of things that will operate over a course of a couple of years or a few months. So I think it's important to see the world this way, just as we do months, days, hours, minutes, seconds. It's critical that when we're looking at data, we have a contextual place to place it. So when we look at, for example, a very valuable, though leading indicator, and I think we'll be speaking more about this, is unemployment numbers. Everybody says, oh, they're lagging data. That's true, but that doesn't frustrate you if you see them as being a multi-month or multi-year indicator. They're worthlessly lagging if you're trading monthly or making one year out decisions. So we have to have all of these indicators are valuable to the extent that they're nested within the relevant time contexts, if that makes sense. We spoke just last week at the event we both enjoyed, where somebody will say, well, I know somebody who's done really well in fill in the blank. And if you look at the context of when that person did well or did poorly, you can understand entirely whether or not that is skill attribution or just fortunate timing. And the same is true with indicators that we look at. I think it's a critical piece, and nobody speaks about it enough. So much so that you'll hear one economist or one forecaster, one business owner reference a piece of data, and somebody else on the panel will dismiss it as being irrelevant. And more often than not, it's not irrelevant. It's just not the framework or the time context that the other party sees the world through. It's a critical distinction, not made often enough.
Yeah, and I appreciate that. And it's almost amazing how same piece of data could be looked at by two different experts, and they see different messages. And thank you for the clarification on the cycles. There are some very long cycles and some short cycles. And well, let's touch on this on the interest rate cycle. So we're in a very long declining interest rate cycle. And now we have obviously drastically reversed the direction. And we went very fast and furious from essentially zero interest rate, the ZERB policy of many years, into now we, on a long-term historic basis, the interest rates we're in right now are not necessarily particularly high. It's just the speed of change was just gigantic from that perspective. So have we entered a period of long interest rates being at least this level, maybe even elevated level, or going to cycle back down? Because there's a lot of people asking the question when the rate's going to go back down. They're no longer asking the questions when the rates are going up or how long. It's pretty clear, at least the Fed has been pretty consistent that they're almost done. They're almost done pushing the rates up, maybe a little bit more room required. And I also wanted to touch on the point that you mentioned, that the unemployment is basically a leading indicator for a lot of economic output and a lot of our coming prosperity for the future. We are at a very historically low point of unemployment, almost strangely low. I'm just concerned, how do we climb out of this situation with the immigration being subdued over the last couple of years? The U.S. is missing multiple millions of legal immigrants that should have come over, and COVID prevented it. And we are in a deep hole, missing great labor, and not clear how we're going to get out of this hole. And this is almost like a structural problem at this point, because you can't get inflation under control without doing something about unemployment. It's the good old Phillips curve. When unemployment is very low, inflation is high, and it's hard to push inflation down, although it is coming down, but it's hard without solving the unemployment problem. So I know it's a lot, but love to hear your thoughts on multiple subjects.
Yeah, there's definitely all important issues, and though connected, they stand alone in terms of what they tell us. I think to the first part about interest rates coming down, just the exact phrasing you used is a perfect indicator right now of you're capturing current sentiment perfectly. And the very premise being, as you said, now everyone's wondering, when are they going to come down? Well, 3 months ago, we were going to ask, when will they ever stop rising? What that tells us, as sentiment being the indicator that it is, sentiment equally occurs at different degrees of scale. How do you feel about interest rates this month, and how do you feel about interest rates over the next 5 or 10 years, for example? It's very, very important that we place the lattice work of some sort of time-bound context to everything that we're discussing, if it's going to be of any value, or we'll end up disregarding critical data and overweighting data that doesn't serve us at this degree of scale. So it was actually back in September, October, at that same event that you and I shared out in Texas, where at the time I was saying I can see interest rates declining by the first quarter of next year, now 2023. The question is, will mortgages come down commensurately with interest rates? And they have not, meaning interest rates have pulled back, and the expectation that they'll continue to fall is now everyone's just waiting. It's just a matter of time. So we've now got a conviction of ongoing interest rate declines, just like we had a conviction back in October of ongoing interest rate rising. What does that say? That tells us exactly what's already happened, meaning that we could now pull up a chart and we would see that saturation of opinion back in November and the saturation of opinion today. It's a very quick turn for sentiment shifts on such a big issue, which is interest rates. So that's absolutely happened. The second point where I said, I don't believe that we can necessarily assume that mortgages will come down commensurately as an equivalent percentage as interest rates might fall. And that has worked out perfectly accurate. The reason I gave back in September, October is that we now have an appetite, a lived experience of inflation. So those that are lending capital are finally, after 40 years of not having to factor it into their expectations, are now going to bake it in until they're convinced otherwise. That will probably be about the end of this year, where they're less concerned about inflation. So I just find it really interesting how sentiment lags what has already happened and serves as a beautiful contrarian spot for us to take the other side. So though we've seen interest rates come down, and we've certainly seen mortgages come down, Mortgages, the gap, the risk premium between the two has widened in the last 4 months I think for exactly that reason. So this brings up the issue of inflation itself. And there's very, very strong econometric modeling that can show this. So very little opinion is required here. But it is known to me, which is to say I'm clear that the Federal Reserve is absolutely not the one that is bringing inflation down, as the CPI has declined consistently now for 6 months. It is not at all the Fed. And we actually know this from data going back many, many years, work actually, oddly enough, by the Federal Reserve and then economists at Princeton as well, showing that really there's about a 1-year lag between the effect of monetary policy on the inflation rate. And the best research for that was done in rising inflation in the 70s and then falling in the 80s. So we've got full cycle analytics that can support this. What could possibly have created it? Well, we know in the commodities markets that the cure for high prices is high prices. A lot of what we've seen is the compensatory opening up of supply channels since in a post-COVID constricted debacle that we all lived through. That is what has made things easier and brought down CPI, which is a far tighter turn. The supply-demand curve speaks to that than Federal Reserve's policy. The question about what's happening with interest rates, the Fed always follows the market. I've been saying this for 19 years. And it has worked out perfectly. The Fed, just as the ECB does, just as the Bank of Japan does, just find your nearest, wherever you live in the world, your proxy for the 90-day T-bill. Wherever the 90-day T-bill goes, the Fed or the ECB or the BOJ or the Bank of Canada or what have you will, all follow as well. What does this suggest? Well, the 2-year note has been particularly valuable to watch through this rising cycle since July of 2020, August of 2020, where we could see the Fed arrives late, overshoots, overcompensates on the downside, overcompensates on the upside, and we continue to believe that Oz has magic behind the curtain. It's really quite intellectually embarrassing. It's fascinating to me, even with the friends I have in finance, including some of whom have managed the largest pools of bond market capital in the world, still are insistent that these incredible witch doctors at the Federal Reserve can control all policy. They don't. And we know this because QE was launched prior to the financial crisis worst days. And the worse things got, the more they threw money at it. If something didn't work 3 times, but it worked on the 4th time, can we say that it works? No, of course not. Nonetheless, watching the 2-year tells me that it's inevitable that the Fed will have reversed policy on interest rates by the end of the year. It's inevitable, just given the lag.
That's very powerful. I appreciate the wisdom, and I love that critical point that the Fed really never leads, they follow. And the size of the bond market is so large that the market itself decides where the prices go, not the Federal Reserve. And the action following the term that I pick up from the book, what's the book name? I'm blanking out for a second, but it's called Long and Variable Legs. So the fact that they push the rates up, could easily take 12 months before the outcome and actually takes place in the economy. So all the action that they've done since they started increasing interest rates until now, not even clear that it's them getting inflation under control. And as you pointed out, it's other forces, not the Fed, that's impacting inflation more than the Fed. And of course, politicians, and they'll take the credit for getting inflation under control, when the reality is it's something else that's driving the inflation, not necessarily Fed pushing the rates up, although it does have obviously impact.
Sure. Yeah. It's just not what everybody thinks it is. To the point about the Fed not controlling interest rates, this is so egregiously misunderstood that even Bill Clinton didn't understand it. When interest rates started to rise in the 90s, he turned to his then Secretary Lawrence Summers and said, "We'll just lower the interest rate." And he said, "Mr. President, you don't understand. We don't control it. You can put it out there, but the market will move your interest rate regardless of what you think." The best example really is look at when people say, well, the Fed, all they have to do is make money cheap. Well, that's exactly what they started doing in July of 2007, fully 6 months before the recession even began, and continued to chase money, the interest rates, drive them down to zero. And yet, what happened? Well, lending still tightened up, Lehman still went bust, housing still fell. Why? Because the United States is a credit-based system. And a credit-based system means you need not just a willing lender, which the Federal Reserve is, but a willing borrower. So if either one of these individuals is bearish or concerned about their future, they just won't show up for the trade, and the entire mechanism breaks down. And this is why, and exactly how, the financial crisis occurred, even in an environment of increasingly cheap money. Because when you are extremely worried about your future, as individuals were then, no amount of free money is a good price. I've already gorged myself on credit. That's why I'm excessively leveraged and upside down, in this case on my house. No amount of making money cheaper changes my outlook for the future. When you're upside down, you're worried about the present. You're not making long-term plans. When somebody is starving, they're not worried about their P&L. They're trying to just get to zero.
Of course, people have to keep the lights on before food and shelter before they do anything else. So what's the forward direction? Where are we going? You mentioned that the 90-day bill or 2-year bill is telling us the Fed will start lowering rates by the end of the year. And I want to take it in the context, it's not just the lower interest rates. We have a massively inverted yield curve, which is a strong indicator of a likely.
Yes, the worst it's been since April of 1981, which presaged a brutal recession.
So are we going into brutal recession? Is that the indication, or can this be a mild recession? Can this be some kind of a soft landing? Because right now, the other point that you mentioned in the past was a guest, and I've heard you speak multiple times. The interest rate is a true gauge of risk. And finally, the interest rates are up, and they're gauging risk, that the risk is on, the risk light is substantially on. Are we just not, is it sort of, it's a little bit, feels like a little calm right now. We're going to see a big storm, or there's still a good possibility there's some kind of soft landing, and whatever that means? Just curious your thoughts.
Yeah. Well, first to the point about the Fed and their the interest rates they do control, which is the overnight rate to a small group of financial institutions. What happens here is any time that the government meddles with an otherwise equal trade, we talk about fair trade, and we little stickers on our bananas that say fair trade. Well, there's no other type. All trade is fair. And if it's not fair trade, it's not trade. It's preposterous. But it makes us feel good. We've got this little sticker on our banana. Any time that the Federal Reserve or the government in any nation interferes with a standard private transaction, we inevitably distort the incentives and distort the risk. The best, largest, most egregious example is student loans. Student loans have been absolutely the reason for the profound spike in the cost of tuition in the United States. So under the guise of helping people, all that's happening is they're giving drugs to drug addicts. And the same is true with interest rates. When you get a public institution interfering in the price of money that they lend to other lenders, banks and institutions, you create a distortion of the risk. You break the light on the dashboard, as we've discussed previously and you just touched on. What this does is that when you distort our assessment and ability, the only real ability we have to, at a glance, assess risk, that's what interest rates are. You know the difference. If I say this government bond pays 20% and this one pays 2%, you know exactly the quality of risk difference between the two. So this distortion has profound impacts throughout society. And what it does is it fuels and rewards speculators and punishes savers. So the prudent are suffocated and drowned out by typically the most nefarious, questionable, and loose risk-playing characters in society. Inevitably, it ends with the FTX type blow-up, where people are speculating so aggressively on free money that they end up trading in things that quite literally have zero value. They have no value at all, but we become convinced that they do, provided we can find someone else to pass the buck to. So to your question about the recession, there's two things about this that have my attention. The first is every single leading economic indicator that has ever successfully anticipated a recessionary call is clearly signaling that one lies ahead, not the least of which is our unemployment rate. At 3.4% unemployment, everybody, rearview mirror looking as they are, if they don't dismiss unemployment because they say it's lagging, again, that's just somebody that's not paying attention to the bigger picture. The beauty of unemployment rates is that they are mean reverting. We know that over the course of 100 years or 75 years of data, what have you, we see a low of 2.9 and a high of about 11 or 12. So if we're sitting at 3.4, a period of rising unemployment always associates itself with a recession, depending on how aggressively it turns. But every leading economic indicator that is worthy of respect, from Michigan sentiment surveys to the suppliers, wholesale purchases, business ownership index sentiments, etc., are all pointing to a recession, at least certainly beginning in 2023. So that feels like a very low, like a soft pitch call to say it lies ahead of us. The only thing that concerns me is that never in my life, having lived through all of the recessions and contractions, asset deflations, hyperinflations that I have, I've never seen a recession that so many people were anticipating or talking about. It seems to be on everybody's lips. And that has the inner contrarian in me saying, this is not contrarian at all anymore, which is strange. That tells me that either we're very wrong and it won't happen at all, or if it does, it will be something that nobody is expecting, which is brutal. So I'm those are the waters that that's the way I'm kind of trading through this myself. It's a really strange time.
Great commentary. You know what it reminds me? Remember the movie Matrix? When Oracle tells Neo, don't worry about the vase. And he is listening to her and turns and hits the vase and the vase falls, drops. And she said, what's going to tickle your mind most is, if I didn't say anything, would you have still broken the vase? So we are in this kind of a conundrum where everybody is saying there's going to be a recession, and everybody's saying the vase is going to break. But the funny thing is, if nobody was saying, and back to your point, it's a very powerful mental exercise that we all expecting. So if you anticipate and you prepare, it inevitably is going to happen, because we are all tightening up, we're all gearing up, we're all scared, and that is a big driver. The consumer sentiment is a huge driver of actual outcome, and the sentiment, both the business sentiment and the consumer sentiment, are going in the wrong direction. So I guess the next question is, as investors, kind of predicting and seeing, expecting recession, we're all sitting with inaction. This is what really just happened. Investors are very nervous and very careful, and they are almost avoiding or reducing their investments unless they can somehow feel some kind of strong downside protection, some security mechanism. So anything that has high degree of risk doesn't feel like it's something worth participating in this environment. So what should investors do? Do they sit in their hands and wait? Or do they continue to invest, and how they change the investment perspective? I'd just love to hear kind of your thoughts, because certainly risk light is on the dashboard, and it's probably a pretty substantial risk. The color is red bright, but what do we do?
Well, to your first point about the recession, I think while it's widely discussed, what is worth noting, if we go one tier lower or deeper into it, you'll see that it's discussed and it's largely dismissed as, well, if we have one, It's on everyone's lips. No one's necessarily saying it's going to happen. Some, uber bears, perma bears are, but there seems to be, just anecdotally, a sense that I'm getting from listening to and reading what I do, is a sense of, okay, well, either no, we'll probably skip one for now. If we do get one, it's going to be mild. Very few people are apocalyptic about it, and that's fine. It's just an observation. So I say that because it reminds me of that beautiful old Wall Street saying that every bull market climbs a wall of worry and slides down a slope of hope. So though this is an observation, that has been very useful for me over the years, where even the bad news is good. That always happens before decline. So yeah, we could have one, but it won't be bad. That's the good news. Likewise, on the other side of the cycle, when we have bottomed and are starting to climb that wall of worry, even good news is bad. So, well, yeah, unemployment is, we're talking about the next half of the cycle. Once the turn is made and we're starting to rise again and things start looking strong, economists and pundits will say, yes, they're improving, but it's just temporary, or but it's, so I've noticed that observation to hold up every time over the years. And it's just an interesting one for me. Even the bad news is good. Versus
the good news is bad.
News is bad. Yeah. I think that this came up in our conversation last week at the event, but talking about our own discernment, I don't think any of us really can afford at any time to be all in or entirely completely out. Having said that, in December 21, January timeframe, I moved to the largest cash position I've ever had as a percentage of assets since October of 2000 or August of 2007. So overwhelmingly, about 90% in T-bills, short-term treasuries, and so forth. Just because why would I do that? So I say I think it's not necessarily sensible for us to operate on all in or all out, which is investors' instinct. Rather to say what merits my capital, it has to be merit-based decisions. And which is to say we need a rule. So I had certain rules that suggested to me that any risk that I was buying at that time, December of 21 through January of 22, was unlikely to be compensated for what I was paying for wasn't worth the returns it was likely to give me. So far, that's played out very nicely. But to do that means we have to have, if you have a rule, if you've gone to cash or if you're considering it, you must have a rule that is going to be as useful when it's time for you to buy again. And this right away eliminates 95% of that instinct to sell everything or to buy everything. It has to be merit-based. If you had a rule to move you to, let's just say, an increased cash position, then that same rule must be the corollary to that rule. The second rule, the other side of the coin, must equally be the tool with which you spot the opportunities and move back in. And I believe that those are presenting themselves and started to in early November, which is, in my case, emerging markets and China. Just to give an example of where we are, of sentiment extremes. We're at a situation right now, say even the CNN Fear and Greed Index is suggesting incredible greed again. Investors are ebullient. Everything that the Federal Reserve does is great. They're on top of it. Any excuse to buoy up equity markets. So this is a beautiful example of a saturation of short-term, of bullish opinion. As I say, even the bad news is good. Even if we are going to, if you can find people to say there's going to be a recession, it's not going to be a bad one. What is the antithesis of that? Well, the antithesis of that is a society where you've got draconian laws, lockdown, social riots and disruption, imprisonment of citizens, disturbance in the streets, rising cost of capital, weakening currency, all of these things. Well, what have I just described? China in October, November of last year. This is a contrarian's dream. This is, Rothschild's blood in the streets, quite literally. Well, why would this make sense? Because Chinese equities peaked in 2007. They've been in a almost 15-year bear market. And the worst among them have been their most speculative sectors, internet stocks. These are the ones that I'm currently, and I stand to be wrong as we speak here on Valentine's Day of 23. I just, not necessarily that I'm recommending anybody do this, I just point to it as being, for me, rules that capture my attention, whether or not I execute on them. They've got my attention. That's my long-winded answer to your question about, what is an investor to do? If you have a merit-based system of what qualifies for your capital, then that system should be running at all times. You're always screening for opportunities, which is where I mentioned Chinese internet stocks, emerging markets, and China as a whole picked up over the last couple of months. Could be wrong, but I'm not seeing any reason to disbelieve that yet. Happy to change my mind though, but I haven't had to yet.
Yeah, I appreciate that wisdom. I think the biggest nugget is a merit rules-based system, not emotional responses to what's happening. Just more of a scientific way to value any asset class relative to its long-term cyclical position, and go in when the market appears to be greatly undervalued versus.
And so there's some things that have.
This is a broad market position. What I wanted to add is it's a little bit different when folks participate in real estate deals. They're a lot more local, and they have a lot more dynamics. Who do you invest with? What you just described, I think, is a very powerful tool on global microeconomic basis, that the Chinese technology companies look relatively inexpensive based on their long-term potential value, and the fact that China is opening up, and it feels like there is a opportunity that those companies can actually prosper
But there's utility even on the local front. As you say, the beauty of real estate is its inefficiencies. That's really the privilege that one is capitalizing on in their strategies. Having someone on the ground that can, say, it's very much like, say, a medical practice or a dental practice, where somebody says, well, this little 3 dental chair practice, it's not worth buying. I would never buy it because, it's too small. Well, I would buy it if it had a 1,000 square foot closet, for example. There's inefficiencies there that I could expand it, and that's really what real estate represents. So you're right, it's local, but the point still remains, which is merit based. What am I looking for, and how does this opportunity compare to what else I have? Because we're always making relative comparisons. Back in November, October of last year, I was, say, just as an example, just follow that thread, looking at the risk and the valuations of US stocks versus the risk and valuations of Chinese stocks. I'm like, completely way more important. But we can do the same thing when we say, this is the yield I'm getting on this particular property, or this is the cap rate I'm buying it at, versus this cap rate, or versus what? It has to be a versus something. All trades are relative at the end of the day.
Yeah, that makes a lot of sense, and it's all. I love this quote, exactly in line with what you just said. Everything is relative. There is no happiness or unhappiness. There's only the difference between one state and the other. If you experience the difference, you can actually appreciate the delta. Yeah. So, but along these lines, and we're running out of time, so just a couple more thoughts, and then we got to wrap up. And this has been great. I'm so grateful for your wisdom. Some of the topics we've covered are just they're both fundamental and critical, how people should think about their investing. The merit rules statement is just critical because most investors don't have those rules. This is why they struggle, because they don't know what is the signal, because you don't have the signal.
Yes.
So now, looking at the fact that you mentioned this earlier, that the 2-year, another one's a signaling, actually, is giving us forward sort of guidance that the Fed should be beginning to lower rates towards the end of the year, even though they've resisted this and they maintained the face and made every statement possible that they're not done fighting the inflation. Inflation is still a big threat, which makes a lot of sense. So are we likely going to see the rates cycling back down into next year? Obviously, recession would be a good driver of lowering interest rates. And what does it mean from investors' perspective in real estate? Lowering rates is usually good news, but at the same time, the concern is, are you getting good enough deal going into recession? This is the biggest question, and it's going to be on my mind and many investors' mind. Are we getting a good deal for this particular asset? Because the fact that the rate's going to cycle back down is a substantial opportunity for real estate investors. You can always refinance when the rates are down, right? That's one of the biggest benefits by locking in today's rates with the expectations of lower rates in the future. But how real is this? How likely the rates will cycle back down, and how likely we're going to see great deals?
I think that, again, going back to the first points we were discussing about cycles, the context of our expectations, the time scale of our expectations, remains, and I'm thankful to have been paying attention to this at the time, but I am convinced that the July-August 2020 lows in interest rates were the lows for the generational lows, those that then bled over 3 months later into 2.65% mortgage, 30-year mortgages. I think that represents the low. I don't see us breaking new lows. That is to say that I believe the long-term interest rate cycle has bottomed, and we're now into a protracted long-term rising environment. But because we're talking about, in this case, a 42 years scale, this could take a very long time. We don't, everyone wants to rush to immediately assume we're going to be at 15% mortgages or something like we were in 1981. Will we get there? Probably, but when? Probably a lot further out than anybody's expecting right now. So over the long term, or really to say over the next 3 to 5 years, let me be more specific, I can comfortably see us in an environment of about 3.5% unemployment, 3.5% inflation rate, and interest rates bumping around 5 to 6%. Very much where we are today, with inflation stabilizing to the downside here through the next couple of quarters. And this would beautifully fall right in line with the historical average since 1950, the post-war period. Interest rates around 5 or 6, inflation at about 3.5. I think that's a reasonable expectation for the next 3 to 5 years. What does that do to real estate? Well, it depends very much on the severity, regardless, we could say recession, no recession, but this will be predicated quite heavily on the uptick in unemployment numbers. And St. Louis Federal Reserve, for your listeners out there, St. Louis Federal Reserve has just phenomenal data freely available to everybody. Go there and have a look at a historical average of interest rates over the last, of unemployment rates over the last 70 years. And you'll see this mean reverting data. And it is a long, slow cycle, and it is a lag effect, but it helps us shepherd our capital, paying attention to the long game, which is really the most important thing.
Yeah, thank you for that wisdom. And reversion to the mean, that's what they call it, right?
Yeah.
So sooner or later, the laws of economic gravity will push that unemployment rate higher.
Which is why that sort of thing is my favorite data. Mean reverting data is my favorite because no opinion is required. That's
right. And that is, and I asked this question, I don't know if we have any more time, but let's just take another minute or two. The unemployment data is obviously substantially impacted by labor participation. And labor participation has been sort of lower and lower. I don't know what it is. People got used to government giveaways and just don't want to go back to work. It's been a strange pattern. Kind of COVID broke a lot of the past patterns and installed new norms. And then if you look back at the immigration point, we're just lagging substantial legal immigration. And I don't know when that's going to come back. But without it, it's just difficult to see, even with a reversion to the mean, how we move unemployment without major layoffs. Or maybe we will see major amount of layoffs to move us towards 5.5%. And I don't know what the historical average, but if you average between 2.9 and 11, you're somewhere in the 6% range. And we are so far away from that we I don't know what it'll take to get us there. And the other interesting point I wanted to bring up, and I don't know whether you feel it is a point of concern or not, but Japan moved to debt to GDP ratio of 260%. We are far, far, far away from that. That forced Japan to turn into negative interest rates. Nonetheless, our debt to GDP ratio has been growing at a pretty steady clip. And it feels like the government has been almost on a mission to expand. Now, it's at least the good news is we have a split Congress, a split government, and the fiscal responsibility sort of stopped from that perspective. But the government can never really balance the budget anymore. So we're just going to see greater and greater deficits. And what my point is here is that the amount of private and public debt, it just continues to grow. And the US economy is riddled with debt. It's absolutely riddled with debt. And the higher interest rates, what you mentioned in the 5% plus range, are they sustainable? In other words, the whole system, can it collapse? Can there be debt implosion simply because these high interest rates, which is a way to gauge risk and a way to fight inflation, are just not sustainable with the amount of debt in the system? It's a systemic problem. So what do you think from that perspective?
Well, debt is a taxation on future income. And so I absolutely expect that we've entered we're about to enter a period of unbelievable debt loads, governmental debt loads in the United States. I think that we've got way further to go. And Japan is a good example. So we have to ask ourselves, what was the net effect? What was the most damaging thing for the Japanese? Well, first of all, we're not Japan at all, but we are in some ways. We're not Japan in that we're not a homogenous society. We have completely different cultural norms. The United States, the average American citizen, unlike the average Japanese citizen or European, has never truly needed to make a national sacrifice. As a function of the United States never having war on their soil except against themselves, we've got multiple generations of a culture that has never really seen or had to make individual sacrifice for the greater good. And the best example of this is look at how Americans responded to COVID lockdowns. I don't care whether people think they were worth it or not worth it. Just look at the response in the United States versus all other nations. In Europe, in the UK, in Japan, everybody else fell in line. The United States didn't. And it's not because of this cry of freedom and so forth. It's because we're not used to making individual sacrifices for the collective. We've never had to put our kids on a train and send them to the north of England because of German bombers were flying in. We've never done these things. This is not bad. I just think it's important and intellectually honest for us to acknowledge it. So I say that because we're not Japan in that way. The Japanese, despite the worst bond market in the world, continue to buy their own bonds with, in some cases, 20 years ago, negative yields, not negative real yields, negative nominal yields. Phenomenal. So what is the net effect? I expect a very, very large growth in deficits going forward and government debt. And the long term, not the short term, is damage to the currency. That lies ahead for us. But I think it's further out than most realize. In the shorter term, as in over the next 18 months or so, the US dollar has to and is primed to continue to decline. But that's not the cycle I'm talking about. I'm talking about the next 20-year cycle where the dollar will lose power. We're not there yet, but I could see that being what lies ahead for us.
Yeah, that's very powerful. And thank you for your wisdom. We are out of time. But this was a great episode. It's unfortunate that the debt will continue to grow, and that's at this point it's no longer a matter of fiscal responsibility. It's just a matter of the country kind of having entered this part of its life, long cycle. Back to Ray Dalio's, you talked about the cycles and how all great let's just call them dominant powers in the world, sooner or later come to earth, and then the next great power rising. And China is on the rise, and the US is on a decline. And the growth of debt it's a potential indication of a potential decline, as you said, we're borrowing from the future generation.
Yep, and we've become accustomed to just letting Washington do whatever it wants without any sort of recourse. The most egregious example of this most recently was the December 22 Inflation Protection Act, or whatever it was called, unanimous, voted through the House and the Senate. Not one drop of ink was spilt in explaining how this was going to be paid for. A $1.2 trillion project. Everyone agreed, wonderful. Nobody bothered to say where we're going to get the money. I think it's so the idea that we have, fiscal conservatives and fiscal liberals for liberatives, is just a joke. It's a joke, and really, although it's not a joke, it ends badly. But shame on all of us for what we tolerate from the quote unquote leadership.
Yeah, I appreciate that comment. Unfortunately, our politicians are no longer doing things for the good of the country. They're doing more or less for the good of themselves. And
it's a popularity contest.
It's a popularity contest, and everyone is in the game for their own interests, and they want to get reelected. They want to stay in power, and it's like John F. Kennedy said, it's not what the country can do for you, it's what you can do for your country. But this was eons ago, unfortunately, and we all need to learn from that expression and hopefully come up with a better national unity. Thank you so much. I'm so grateful. Appreciate you coming on the podcast. And is there any way for folks to reach out to you and learn from you? What's the best way to follow you?
I have gone so many years without so much as a website. My assistant built one for me last week. And so there's a contact form. If anybody wants to shoot an email or we have a conversation, they can reach me at sovereigndentist.com. For some reason, that's the site, but they can find me there. And but no, otherwise, it's always a pleasure to be with you, Mike. And let's not leave it so long this time.
Thank you, Alistair.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.